Hi, this is Alan Lantz, Director of Research, LanczGlobal. Welcome, everyone. Glad you could make it. I hope everybody is safe, healthy, and happy during these crazy times. We're here to answer your questions. Feel free to submit them. We're going to do our best and let you know what we're doing and what we were doing, because that's just as important. Here's a video from what we were saying 11 years ago, before or in the midst of the financial crisis, before the recovery started.
All right, everybody. Hello from Bloomberg World Headquarters here in New York. I'm Carol Massar, in today for Rhonda Schaffler. You are watching Bloomberg's Open Exchange. Our first guest managed to steer clear of the tech bubble and its subsequent burst. He also avoided financials last year. Alan Lantz is editor and publisher of the Lantz Letter and director of research at LanczGlobal. He joins us in studio on this Friday. Good to have you with us.
Thanks, Carol.
I want to ask you, Alan, you did avoid a lot of bubbles in the past, including the financials. How come? What kind of kept you away?
Well, there's a number of things. I think when you look at transparency, accountability, and greed, and those are all mixed together, it's usually an area or a time to be very careful.
But what specifically? What tipped you off that you were seeing kind of greed if you were within the financial community?
Well, the financials, what we saw is they kept on increasing their earnings, but it was how they were increasing their earnings. They were doing it by excess leverage. They're increasing their dividends. Unfortunately, that made a lot of conservative investors get in, thinking it was almost like a utility or a safe investment, when actually they were taking more and more risk, and that's how bubbles are formed. We have to say that was 5 weeks before the bottom in the financial crisis. It was an interesting time. We were getting a lot of feedback, as far as from investors on why we're buying Apple. Split adjusted, that was $10, $12 a share we were paying. We started paying $18, $20, kept on going down. We bought more. The interesting thing is that basically it's a situation where now, almost 11 years to the day, this is what we had to say as far as 5 weeks ago regarding the stock market and the valuations.
Advice there. And the last question we have for you, Alan, says, what are your thoughts on the stock market?
Well, we actually started taking profits last couple of weeks as the market was moving higher. We said it was going to be a much more volatile year, and that's what's happening. Companies like Microsoft and Apple are great companies, but we started to sell some just because of the incredible gains. A good pullback here would be actually a positive, I think, for the long-term health of the market. And a few quarters of major gains would set us up for a big fall. So I think this escalation of this coronavirus that occurred this weekend has really pressured stocks overseas and in the U.S. And I think that's a good thing. It shouldn't just go straight up. Our clients and members and subscribers have been just absolutely incredible. They've been with us a long time. They know our philosophy, and it's a situation where we have to thank them. They've been very helpful into this and helped us be ahead of the game when it comes. And that's why you see videos like 2009 and as far as January this year, talking about volatility in both directions instead of the market just continuing to move up. And just one final note, when we said that this is good, that was in January, before we even underestimated the coronavirus. And obviously, the situation has gotten much more dire. So it's a matter of, we're expecting a 15, 20+% correction in the market because of valuations. The coronavirus actually created a situation where it's much more severe than that. We're talking about 35, 40%. This marked the fourth time in our history of LanczGlobal that we've warned investors on these bubble type valuations and risk in the stock market. And it's interesting because it's usually something surprising that no one expects that creates a dramatic sell-off. And the more surprise, the greater the surprise, the quicker, more accelerated the sell-off. We saw that in '87. The surprise there was portfolio insurance. Everybody thought they were protected with this new gizmo gadget called portfolio insurance, and what they found out, it didn't really protect them. It only protected them for a small decline, and that created a 22% one-day drop. Obviously, the surprise here that created a much greater downfall and precipitous drop than what we even expected was COVID-19, the coronavirus. And it's a situation where I think the double impact occurred here with this video from last week, as far as the first week of April on energy prices and the double whammy.
Andrew, Saudi Arabia and Russia have been in a price war. Production was way up, and with demand going down, the pandemic, the market was oversupplied. At the urging of President Trump, Russia is looking at cutting their production, and OPEC will gather this week for an emergency meeting to do the same. Alan Lantz, a financial advisor for Lantz & Associates. The good news, you can buy cheap gas. The bad news, you can't drive anywhere right now, can you? Americans and world energy stocks were taking a beating. That's really bad, especially if you're an investor, even with a 401k retirement plan.
They might, bite the hand that feeds them in doing this, and it'll cripple them. But they see this as their one advantage to do it, and that's why they're doing it. The timing had us in a very vulnerable position, and it's unfortunate. We got the dual whammy, and that's why you saw the market down 37% before the rally last week.
So that was another unexpected occurrence. Saudi Arabia and Russia not agreeing to put limits on as far as volumes, exports on oil, and it increased the glut. Again, I don't know if it's a matter of switching and trying to destroy U.S. independence in energy, but the timing was just incredible compared to what's going on now, or in combination with what's going on now with the coronavirus. We're starting to get some questions in. And the first question is, what do we mean by thanking the clients for helping our assessment of this crisis situation? I think we mentioned that in the beginning of this webcast. And our clients are really exceptional. They've really seen and understand. The ones that have been with us, all but the newest ones, of the importance of mitigating risk and these bubble type evaluations, and they realize the importance and the difficulty of making up for huge losses. And basic math will tell you that a 10% decline can be made up with an 11% gain, and a 30% decline in valuations would take a 43% gain. A 50% decline, need an incredible 100% gain just to get back to even. And I think, what we do is we look at the behavior analytics and investor sentiment as critical plays in finding market trends during extremes like this. And, in an expression of how, or example of how our clients have been helpful. A client called us while on vacation in Hawaii a few days before planning to fly back home, and they basically said, I know we have a lot of cash. I'm really grateful that we have this cash available instead of being fully invested. I want to make sure you're utilizing that. This was in early March, and we said, yeah, that's our intent. We're going to hold off for now, but if there's capitulation, panic selling, we will take advantage of the situation. Almost 2 weeks, literally to the day, they called back at home and said, have you bought anything? We said, no, not yet. And I thought, why aren't you buying, or something like that would be the follow-up response. And the follow-up response totally floored me. He said, I'm grateful you haven't bought. Why don't we just sell the few positions or the holdings we have now? This is going to be, much worse. Told them about the capitulation selling and that's what we're waiting for. Instead, we're getting these 4, 5, 6%, drops every other day. We're not getting back-to-back up days. They haven't had one before this past week since March 2nd because so many people are fully invested in these index funds and or margined, where any kind of up day they got to sell into. So, that really gave us the inclination that if somebody with so much cash, 60, 80% cash, is making a complete 180 in over a 2-week period that understands the long-term dynamics of the market and how valuations fluctuate. What are these people that are fully invested or in their 401k, just been riding along since our video of 2009 about getting back into the markets, and how are they going to react? So we figure there's going to be more tough sledding. That's what happened. The market looked like first bottom here. It's March 23rd. Incredible lows. I think we're off 34, 35%, which in the pandemic of 1918, I think the markets were down 37%. So it really gives you an example of how intense and over a short period of time this was. And again, because it was a surprise of this pandemic. It's a situation where you can see on the chart on the screen now, in 87, when we were 70% cash in the summer and the market went down, that's actually when we did our first interview on a national level. CNN asked us to if we were buyers, and we said yes, and they offered to fly us out. Back in those days, it didn't have the satellite and the technology to do remotes, and they flew us out to Chicago, picked us up in a limo, took us directly to the studio, greeted by the producer, so glad to see you, Alan. And I thought I was a real hero until he said, you know how many people we called? We probably called several hundred people before we finally found somebody that was buying. And all of a sudden I realized it wasn't because of us. It was just they're trying to find somebody to buy. That's what I call capitulation selling. When everybody's selling, they don't care what price they're going to get. They just want to get out. And fortunately, we were buying into that. Our banker said, it was foolish. We're exposing ourselves. And back then we needed bankers from a standpoint that when you don't need a banker is when they bother you the most. So we really took heed of whatever our banker said. So much so that before we flew out to Chicago, we talked to our mentor, Sir John Templeton, and just asked him if this is the right thing as far as buying. You always taught me to buy when there's blood on the streets, and I've never seen anything like this, even though I've been watching the market since I was 10, 12 years old. And he said, yeah, certainly it's time to buy. Alan, I can't tell you it won't go lower. Some of these companies are starting to trade, below their net cash, which makes no sense. So when you're dealing with human behavior, panic selling, it could go lower. But 2 years from now, I can tell you that, these purchases of quality companies will look, solid. So the question was, is this another 1929? We were the Midwest advisor, and there was a New York advisor and an advisor out of LA. And the question went to the New York advisor, and he said, yeah, get out of the market, be in gold, et cetera, et cetera. The West Coast advisor then went on, and again, I'm thinking about what I'm going to say, and went over it with Sir John Templeton, that back then we didn't have, we did all the wrong things. We increased interest rates. We tightened the money supply. We've already lowered interest rates. We've already loosened up the money supply. Back then we didn't have in 29 Social Security. Now we've got these added measures like Social Security added backstops. And the West Coast advisor answered, is this another 1929, by saying no. And I thought, oh my goodness, he's going to take all what I have been thinking and wanting to, as far as expound on in my national TV debut. And I'm going to just say, yeah, everything that LA guy said, ditto. And instead, I'd never forget what he said to follow up his no response, if this is another 1929. He followed it up with, it's going to be much worse. It's going to make the 87, 88, 89 and beyond, it's going to make the 29 depression look like a financial picnic. Well, that's all I needed to hear because Sir John was saying that, sensationalism and what have you really get people emotional and into this panic selling. So I said, it's just a matter going through what we've done as opposed to what we did, all the wrong things in 29, and that this is an opportunity long-term wise, and investors should be buying into this and not panicking out. They're going to regret it as long as you're investing with monies that you can invest for 2-3 years, because you never know. And that was our initiation. with national media, and in 2009 when we warned about the financial crisis and said, we'd even sell real estate. We think everything is getting into bubble valuations. We heard that some people don't read Barron's or the Wall Street Journal. They don't watch Bloomberg or CNBC, because we were doing CNBC every other week back then, trying to warn and trying to expound on our research. And they watch maybe the local, or they read the local papers, or watch the local news. So we made a concerted effort, and that's what you see on the top right of the screen. The bottom left is the first on CNN, and we don't even have a video of that. It was so long ago. But the top right is what we talked about January 27th this year. And we got a couple other questions coming in. Are there any positives out of all of this? It's a great question. Good attitude. I like to see from the audience, and there are a few. Interest rates are going to be lower and sustained low for quite a while. So refinancing, if you have floating rate, make sure those rates go down. If you have a home equity or whatever, negotiate with your banks with these loans. And then on a macro basis, I think the supply chain being improved from a standpoint of less reliant on these other countries, particularly China and India, so that we can come out of this smarter and much more independent. I think that's going to be a couple of the keys. The biggest challenge is going to be what to do next, and that is a situation where I think the next 45 days are going to be critical. In this past week, the stock market went up more than it did any other time since 1938 for the Standard & Poor's 500, the S&P 500 that a lot of investors are in. In 2009, when we saw that first video we showed, was the best the stock market ever did in the NASDAQ, the more tech-related companies, since 2009. So the key here is where are we at? Because in 1938, we had the best week ever before this past week, or since this past week, and the stock market in 38 from that phenomenal week went down another 43% subsequently. While obviously in 2009, after best week in NASDAQ since the week that we just finished here, ending April 10th, 2020, what we have is a market that went straight up for 11 years before you saw the video in January, end of January, where we were talking about taking profits, and even some great companies like Apple are getting to a point where partial profit taking makes some sense. I don't think we're going to see the V-shaped recovery, unfortunately. I'd love to be able to tell all the listeners that we're going to see a V-shaped recovery and the economic turn on of we're shooting for May 1st or slightly, hopefully slightly thereafter, will spawn a back to the old days normal business environment. I don't think it will. It'll be some type of rolling out regional and planned strategy, which is good. I think we got to get back to normal as quickly as possible. So, but there's a fine line there. It's almost damaging if you open up the economy too early, and there's a wave, a second wave of the infections to come, and that will really destroy any confidence in the economy. Or if you keep the economy shut, and we've never seen anything like this. I mean, it's been amazing. Janet Yellen, ex Fed chair, was on this week, and she was quoted as saying she couldn't believe the unemployment numbers. And we're telling people to go home. We're telling essential businesses to stay open, but all other businesses to close. as we're broadcasting here, we just heard that the governor of Michigan is saying all businesses that aren't defense related, totally essential, or supplying food should be closed. So even like a Walmart would be closed for the part of their business that sells clothing, etc. Only their grocery side would be open. I mean, those are going to be very hard maneuvers to come back from, and the more we see that, the more we're going to be leaning toward 1938. Not that it's 4 or 5 years and another 40% down, but that we're at best looking at a U-shaped recovery and not a V. And that's if things are executed to perfection from here. It's almost a drop in the bomb type decision, unfortunately, where we have to decide if we keep the economy locked up and create despair as far as financial problems for decades and generational suicides and just a lower standard of living, or we open up the economy and create the problem of potentially resurrecting this virus. So that's where we're at. What we intend to do is we did a little yesterday, just selling into the strength here. The market's up 50% from its bottom. Could go higher. If it does, we will lighten up on the weaker positions. In one of the videos, I don't think we played it as long, but would be happy to send you any of these. We talked about there will be companies that really thrive out of this, and in early March we were saying, buy the UPS, Amazons into this weakness. Take advantage of companies that are strong financially that can acquire their weaker brethren out of this at pennies on the dollar. And I think in a multi-year time frame we'll be okay, but we wouldn't be chasing. And if you own too many stocks, just like we said in January through February when the market was hitting new highs, take some profits, don't be greedy. Now it's a matter of if you're exposed too much, lighten up. You should have cash, and you should have that availability of cash to be able to take advantage of panic selling, capitulation, or whatever's to come. But I think it will be a longer road. Another question here, and we're running out of time. If you have other questions, please feel free to submit them. We'll answer them on the next as far as web chat. But what metrics or what are we focused on in the months ahead? Basically, what we're looking at here is the restart, like we talked about. The sooner the better. There's a fine line there, so I know we have to look at it from a scientific standpoint as well. It's a very tough decision, and it's hard because you've got this dual as far as role. Hopefully, it doesn't get political, and we really do what's best for America. Other things we're going to be looking, or we have been, and we will continue to look at, are just how other countries like Austria and Germany, Hungary, and even like South Korea, how they're doing with their startups. We're monitoring China as much as we can, with the businesses that they've opened up, but it's just really hard to get information there. But looking for that second wave of infections and learning from it will be critical. The heroes here are the healthcare, the first responders, incredible efforts. But really the cavalry, the second phase heroes, will be the pharmaceutical biotechnologies that will develop the therapeutic that will get us out of this and really build up confidence. Until we get that, I would make sure we have cash available, make sure we take advantage of as far as panic selling and weakness. One final question here, and again, thanks for your time. Really appreciate being able to share our thoughts. Let us know what you think. We did a uncut version of this last Friday, and we'd be happy to send you that as well. There's a final question here. How would you rate the administration on how they handled this pandemic? Just in general, we don't want to get political, but we look at what kind of effort is being brought out by businesses and organizations, and they should be working harder and really taking on emergency measures to do all they can to improve the situation. Those forced to be working at home right now need to put in extra effort, because the situation, and this is part of, again, much more so the health side of this, and it is a tragedy, and we feel for everyone, especially as far as that have lost or have had as far as death and illness in their families and loved ones. But working out of home is obviously just less efficient. So again, trying to model in a V-shaped recovery, our economy is not going to be turned on by a light switch. This is going to be a systematic, slow process, and that's where I think it's going to be difficult, especially with the market bouncing up so much, and why we'd be more inclined to take money off the table and make sure you have the gunpowder. Now, if you have 60-80% already in cash, it's just a matter of upgrading the portfolio into higher quality, and like I said, lessening the lesser quality names, the weaker counterparts, especially in sectors that are going to struggle, like retail, like energy, like as far as obviously travel, hospitality. They've had incredible moves. Carnival was up 46% this week after being down 55% the week before. Think about that. It's still down significantly even after one of the best weeks ever. If unfortunately you own some of those stocks, I would definitely lighten up. As far as the effort, it's a situation where Bank of America, many of the community banks that have led the way really with like the PPP stimulus loans, which are really relief, not stimulus. They've worked through the weekend, this past weekend, and late at night, and Bank of America had an app ready for PPP. I know we're here at LanczGlobal working 6.5 days a week, and we're looking for the slightest piece of new information that can really make a difference. These are going to be really volatile times, and it's important to communicate. It's important to really do your best. And we've heard where people are working out of their home, and after they put the kids to bed, which is great, they look at portfolios. I mean, that's no time for looking at portfolios in the evening. When there's such dynamic changes going on. And again, it's what we usually see. It's reactive investing instead of what we try to do, which is proactive investing. So now it's like, what should we do to put our money for best use, as opposed to scrambling on, what we should be doing now because we're in this predicament. We've been interviewing professionals with solid resumes that don't feel comfortable at companies they're at, either the company's finances or the way they do business practices. It's a great opportunity to hire quality minds, and that's what we all look for here, even with our internship program at LanczGlobal. Banks, many banks are acting like there's no difference, with the exception they're working from home. They really don't understand how difficult it'd be to restart this economy. And I think those type of banks that have struggled with the PPPs, that really have taken care of just select clientele and what have you, are going to come out of this as far behind. And there'll be a lot of changes going into this. We'll cover next week, and some dramatic changes from real estate to the stock bond markets, and even into how we see things unfolding as the economy opens up. Again, thank you for your time. Really appreciate all your interest. The response has been incredible on the first series of these, and we'll continue to improve on these, and really appreciate your feedback and your response and any comments. Have a good weekend, and all the best.